Hi, I'm Jarrett Davis, and I was ranked as the second best performing Forex trader in the world by the Barclays Currency Traders Index. Now, the reason for this video is kind of a response to all the wonderful comments and questions that I've been getting from all the stuff I've been posting online, the daily trades, analysis, economic news events, all that stuff designed to help you guys become more consistently profitable and give you an insight to kind of just show you how professional traders operate in the Forex markets. There's a lot of stuff, a lot of courses, a lot of so-called gurus teaching absolute nonsense, and the goal of all this stuff is to show you for free how professional traders trade. So hopefully you've been able to see the power of that, but obviously that provides sometimes a lot of questions. So you guys have been posting that, and what I've done is I've taken the most common questions and tried to make a series of videos like this one to answer them. So this particular video is going to be focused around the question of what is the difference between backtesting and curve fitting. Okay, good question. Curve fitting is probably what most traders who are trying to backtest do. Okay, backtesting is not much better, to be honest. It's not much better, but backtesting has the belief that if something works over time, it will keep working in the future. Whereas curve fitting is even worse. Okay, so basically, we're going to explain the two. So a backtest is designed for this. So you have a strategy, you create the strategy, you create the sell signal, the buy signal, etc., etc. It's generally technical, it's very mechanical, same every time. And then what you'll try and do is you'll then, okay, there's the rules, and then you'll go back over a price chart generally, as far as you can, and you'll like, okay, well, there was a signal, did it win, did it lose? There was a signal, what happened? There was a signal, what happened? And you'll basically write down the results. And at the end of it, you'll say, okay, over that period of time, this strategy won 60, 70% of the time, 80% of the time. So if I keep, so in theory, if I keep trading this strategy, I'll win 60, 70% of the time, surely, okay? Curve fitting is where you have the price action and you basically look for patterns in that price action and then basically try and create a strategy for that period of time. Okay, so you can see the price went up here. Okay, so what gave a buy signal then? Okay, that. And you basically create the strategy based on that. So that strategy is perfect for that period of time, but it's very flawed because it doesn't, you're not going to be prepared for the future. Okay, who knows what's going to happen in the future? Backtesting is a little bit better. It's a little bit more robust because you come up with the strategy first and at least you can apply it to what happened in the past. However, the only kind of problem with backtesting is basically you look at a price chart and you will only pick out the strategies that worked during that time. So if you have a strategy and you backtest it doesn't work, you'll ditch it, okay? Which a lot of strategies will be no good. But some strategies will work, but that has absolutely no bearing on what's going to happen in the future, okay? So the price action is completely random at any given time. There's no way of knowing which way the price is going to move because the market is driven by fundamentals and sentiment. So if something happens in the news, that will drive the price. If a big geopolitical event, if a war breaks out, if a central bank decides to change its policy, all those things that interplay at any one time, that's what's moving the markets. So what's happened in the past, this price action here, has got no impact on what's going to happen in the future. So backtesting in itself is useless. And you'll know that if you've tried to backtest a strategy. If you've been through this process, you'll know it's true. You'll get a strategy, you'll backtest it, it looks amazing. You'll start trading it, within a week it's failed. It's no good, you've lost. Okay? It's nowhere near the results you're getting from the backtest. Okay? If that's happened to you, which it probably has, it happened to me loads when I was learning how to trade. That's the problem, okay? It's because backtesting doesn't really give you anything. Curve fitting is even worse. Curve fitting is when you spend hours trying to mold the strategy to the price action so you can perfect your results. So for example, you get the strategy here and it produces a win rate of 70% and you make 400 pips. Okay, how can we make 600 pips from this? Well, okay, if we adjust the take profit here, if we adjust the stop losses here, and basically once you get into that, then you're curve fitting, and that is completely useless because it won't help you going on to the future. Okay, so I hope that helps. That's the difference between backtesting and curve fitting. Curve fitting is horrendous, does not work at all. Backtesting doesn't really work. It's not much better, but it is at least less flawed than curve fitting. So that's the difference. Please keep your questions and comments coming. Very, very useful, and I will try my best to do more of these videos, and I'll be back soon with another video on a different topic.